You caught us on a great day. We're prepared to give away everything. 5 things people don't know are wrong with their retirement accounts. I have a very special guest in the studio. His name is Maurice Kempner. Maurice is the CEO, the president, the man in charge over at MINUTEMAN Taxpayer. Maurice not only has some critical information for us today, also a couple of very special gifts for our YouTube audience listeners that are attending today's training. For those of you that are new on the channel, we help people go further, faster financially, and we do that through what I like to call the 3 C's of proper banking and borrowing. Maurice and I met the same way that you probably have discovered us, through training. Maurice is definitely an industry expert, and I just really wanted to bring a lot of what Maurice is teaching his database and his clientele to you guys, because there is huge value in this. So Maurice, why don't you just take it away and help walk us through what you think are the 5 most important things people don't know are wrong with their retirement plans.
The first thing I have a problem with is inflation. Inflation in the United States runs about 3% a year. So that means after 10 years, you have about a 30% loss in the value of your money. After 20 years, you have 60% loss. This is just a rough estimate here. So that means if you retired 20 years ago, the money that you had in your retirement account on that day, the day that you retired, is worth about 60% less now than it was then. It has 60% less buying power now than it did then. And that's based on how you measure inflation. A lot of the inflation measuring tools that the government and other sources use aren't really that accurate. Inflation, I think, is probably higher than the 3%. And so what happens is it turns into a race between you dying and your retirement account running out of money. Which is going to happen first? You're going to run out of money first, or you're going to die first? Because the only way you won't run out of money is for your retirement account to generate enough improvement or appreciation in the value of the stocks and mutual funds, which are usually in it, securities like that. Those have to go up enough to cover inflation and the increased amount that you have to take out every year due to inflation to pay your bills. So the next one, it's not multi-generational. I will tell you a personal belief of mine is that your life, the quality of your life will be greatly determined by the quality of questions you ask yourself. I think a better question is, how do I have enough money in my retirement that'll increase with inflation and the cost of living, and then leave a paycheck for life to my heirs? Right? Now, if I ask that question, I'm going to get answers to that question. Then a 401k or an IRA is not going to answer.
Not even a possibility. Exactly.
No.
Okay.
So real estate, for example, is one of the things we do with a lot of people, or helping them with a business they've already got. Now, if you've got a business and it increases over time, or real estate values go up, rents go up, tenants pay off the property. So from the time you retire, and you've been buying real estate instead of putting money in a 401k, for example, from the time you retire until you die, it's not a race. And then when you die with that real estate, your children or your heirs inherit it, and they collect a paycheck for life that goes up with inflation and so on and so forth. It solves all these inflationary problems for the most part.
Okay, so then what would you say is the third biggest reason that retirement accounts
yeah, anytime you do anything with anybody. So if you open a checking account at the bank, you have a partnership with that bank. It's a business partnership. It's a kind of mini marriage. Now, in this partnership, just think about this. What we always tell our clients is the number one thing you want to do is accumulate assets that generate cash flow. That's what my family always told me. Accumulate assets that generate cash flow on a regular basis. Stocks and mutual funds very rarely do that. You just hope they go up in value.
No question.
You invest all this money. Your partner, whoever that company is that brokers your retirement account, they invest no money. But they make money no matter what, because they charge fees on the money that you put in there, whether you make money or not. So they just, when you put money into a retirement account, they do exactly what I was always told by my family to do, which is a family of multi-generational wealth. They have now acquired an asset that generates cash flow on a regular basis. You haven't. You're not going to get this money until you retire. And then you're only going to get cash flow if it makes enough money. And then you've got all these problems with inflation and other things. But as long as you've got money in the account, they're going to get a regular paycheck from you no matter what. So if I came to you and I said, let's be partners, you're going to invest all the money. I'm going to invest none of the money.
Right.
I'm going to charge.
I get paid no matter what. You get all the risk.
Yeah. And you take all the risk.
Right.
Does that seem like a good partnership to you?
Probably. Yeah, I'd pass. Okay. So we've got inflation. We've got things are not multi-generational. We've got that we're establishing some bad partnerships. So what's 4 on the list?
4 on the list is usually you're going to pay higher taxes. Okay?
Because it's on the harvest, right? You're not paying on the seed.
Yeah, because as you make more money, even though a lot of that money is just replacing the value of money you lost due to inflation, they're still taxing you on it. Higher taxes is a big problem. Now, if you have real estate, for example, and you have cash flow, there's a lot of tax deductions. For example, depreciation. You can depreciate the cost of the building and other assets tied to the rental property, even though they're actually appreciating in value. You can deduct them as though they were losing value, and you can deduct a certain amount every year. And if you finance the property after you pay your payment and your insurance and your property taxes and all that, a lot of times we bring our investors where all or most of the positive cash flow they're getting after expenses is tax-free just because of the depreciation deduction. But all businesses have these tax advantages.
And the last probably dovetails very well into that, right? Because basically all 4 bundle up into that 5th one, which is kind of essentially just a loss of control overall.
Some people feel like if they just get a job or they let somebody else handle their retirement, that it's safer because then they don't have to worry about it. And they think, well, these people are the experts. Well, you know, in this last financial downturn, there were financial businesses that went under. I mean, when you own your own business or you have your own real estate, you control it.
That's right. I've always found exponentially greater safety by being in control. And I can't tell the listener enough, guys, if you're not proactive each and every month, you're missing out on so many opportunities and truly beyond your imagination. So it's time to start thinking a little more creatively. Relying on people and experts like Maurice is very important. The more sets of eyes you can have on the same equation, the better your decisions are going to end up being. If you guys want extra sets of eyes on what you're doing, it's really important that you visit the bio below, the description section of this video. We'll put a couple links in there as well as an email address. The email address is contact us at VIP Financial Education. Send us an email. Couple gifts that Maurice has promised you guys as audience members of this channel. And this is not something he does for everybody, but one of those gifts is an account with EMONEY. Now, EMONEY is much like the service online like Intuit, where you've got essentially an interface with your current financial accounts, all of your credit cards, your checking accounts, savings accounts, etc. And essentially it'll allow you to do all the reporting and essentially budget management things that you need to be taking care of each and every month. Obviously, we provide one copy of a cash flow cruncher spreadsheet to every viewer on the channel. That's a gift from VIP to you. We've gone one step further. We twisted his arm, demanded, in fact, that he supply a coaching session as well. So everybody that comes in through this training will be able to request through that email address their own evaluation. So you can see, where do you stand compared to where you want to be. It'll require you to take that next step. So send me an email. I will personally take a moment to make a warm introduction between you and Maurice. If you haven't already, consider subscribing to the channel. We're always here talking about really cool ways to get the upper hand on the banks. We do it through credit, capital acquisition, and cash flow maximization. And we'll be back with Maurice before you know it. So stay plugged in. Turn on the post notifications by clicking the bell after you subscribe, and you'll be notified every time we release new content. It's coming out every week, guys. So we'll see you on the next episode. Until then, make it a great day and take care.
Bye.